All right, everybody, we'll get started so that I can move on to preliminaries. And as more people join, they won't really be missing any of the meat. I want to start out thanking you for your time. Just as a reminder, if you're here and you need SHRM professional development credit, that will be available. I can email you a certificate of completion and it'll have the activity code. I do have, and you'll see the agenda, I do have a QA check, which I'm required to do by SHRM to make sure you didn't just turn on the webinar and go to sleep or go to multitask or something else. And I know that sounds silly, but have to do a little QA check. There's a key word towards the end of the presentation that I will need you to email me, and that will be my QA check that you actually participated in the webinar. But today's topic, fiduciary training, fiduciary best practices in hiring and monitoring ERISA plan service providers. So just a general outline of who the audience is, who you are, and what I'm going to cover. So to start out, who the audience is, just from the registrations, and I can tell from the names that are here, that some of you are here as plan sponsors, as committee members, as plan fiduciaries, and you're wearing the hat of selecting service providers, whether it's your advisor, your record keeper, and certainly talk about ERISA attorneys, auditors, but those are the third-party service providers we're talking about. Some of you are advisors, and you're kind of wearing a dual hat here, meaning you're helping your clients perhaps choose a record keeper or a wellness vendor or a managed account service, but you as the advisor, you're also trying to be the person to get hired as a third-party vendor. In general, I'm going to speak to you all as though you're the one making the choice on doing this hiring process. And advisors, when you wear that other hat, you're trying to present to a potential client, just you'll have to translate that on your own. So two big parts of this. What does the Department of Labor say about this process? And I've got a graphic that will make it pretty easy for you to tell that I'm talking about the guidance from the Department of Labor. And then the second part is, well, what's the more practical side of this? You know, don't just tell us what the Department of Labor says, but how do I do this practically speaking? How do I, as a committee member, make sure we're doing what's right by our plan, what's right by our employees? We don't do this very often, so I need a little help and a little training on that. And we'll break that down. And the last preview I kind of have on this is we have to talk about cost of these services, but cost and how it's assessed and how it's paid is a totally different topic. I'll do that in a fiduciary training session for another day. But we do have to get into that a little bit at the surface level, that if you're hiring a service provider, you obviously need to understand what the service is and what the real cost is. So we'll get into that a little bit, but it's not a presentation on cost. Here's our agenda. Fiduciary overview. I gave last month a presentation that was just an hour on basic fiduciary duties. Real quickly, we're going to review those and how it applies here. Talk about DOL publications that give guidance on that. And I'll go into that. And there's an additional publication just on fiduciary duties on cybersecurity. We'll talk about this. And then when we get into kind of rolling up our sleeves, how do you handle conflicts of interest, or how do you uncover potential conflicts of interest? I won't say rarely, but there aren't often where it's a pure conflict. But there's more of a potential conflict, such as you're hiring a record keeper, you're going to hire principal and use some principal proprietary products. Well, there's a potential conflict there. It's not the end of the world. It's not wrong for you to do that. It's just a matter of disclosure. We'll talk about RFPs, requests for proposals, talk about benchmarks, next steps that you might want to do, future webcasts, and then that keyword for SHRM, professional development credit. So a little bit about me, and I want to focus on not the picture of the submarine poking through the ice, but as it turns out, I was chief engineer on a submarine, a lot of checklists, a lot of process, a lot of procedures, and you follow those to make sure things go right. If you don't follow them, occasionally things will typically go wrong. Sometimes things go wrong all by themselves for no fault of anybody else, and we had procedures and policies how to fix that. So that translates very nicely over to ERISA. I do some expert witness work in class action lawsuits. I try to look at the lessons learned from those cases, preserve confidentiality. What did we learn from them? What could you as advisors, you as plan sponsors, committee members, or other industry professionals, what can be learned from that experience. And I want to share that with you all. So that's my goal. My mission is to educate and equip power plan sponsors, the committee members, advisors, everybody else in our business. How do we make your plan, your knowledge, how can we make it just a little bit better to get better participant outcomes from everything that I've seen? And then obviously ERISA fiduciary training. My goal is to do a broadcast like this once a month. If you're a committee member, please share it with your other committee members, your peers. If you're an advisor, please share this with your clients. I'm just trying to touch as many people as possible. Here is a giveaway for you. If you're not into QR codes or this somehow is difficult for you, but I had an advisor team once ask me, hey, Eric, do you have a publication or a checklist or something that a new committee member could just download, they can look at and say, hey, here's where to get started? And my initial answer was, no, I don't have it, but I think it's a fabulous idea. This is a great place for a committee member to start with. Hey, here are the documents for your plan you need to understand. And oh, by the way, here's a handful of documents for the Department of Labor that'll help you understand your duties. So the QR code will just ask you to fill out some information, and you can download it. If you're not into the QR code, just send me an email. My contact information will be at the end of the webcast. And say, I'd like the committee member checklist. Let's go over the 4 basic ERISA duties. Now there's 3 add-ons. I always call them add-ons. Depends on who you talk to. They might say, well, you need to add this one, but we're going to focus today on the first 2, the duty of loyalty and the duty of prudence. But real quickly, what these are: loyalty. You need to act in the best interest exclusively, and exclusively is a key word in there, exclusively in the best interest of your plan participants and the beneficiaries. All right. So a decision on how you run your plan, you operate your plan. So specifically in selecting service providers has to be exclusively in the best interest of your participants. And I'm going to give you 2 examples. One was a good one. One ran afoul to this, where I've had clients in the past. This was outside of class action. But I said to a key committee member, and really not the chair, but she pretty much ran point on getting everybody together and kind of was the informal head of the committee. I said, hey, it's been a number of years since you've done a formal bid for your record keeper. How do you feel things are going? Do we need to do a competitive bid? And her response was, well, as a participant, as an individual, I'm very happy, but we'd have to talk to HR and we'd have to talk to admin. I don't know. I can't speak for the service side of things. So here's a case where this individual thought, well, my opinion's not the only one. We need to look at the whole plan and the employees and the participants. And is this going right for them? Flip side, I had a case where I had a client and we were in the middle of a search for a record keeper. And this one committee member, he didn't come out and say it, but he had a hard preference for one record keeper based on his own personal past experience. And that got in the way of his ability to make an independent decision on what was best for the company. So just remember the duty of loyalty, what exclusively is best for your plan participants, not because you like a particular record keeper. And by and far, the biggest violation of this is in smaller companies where a C-level executive hires their friend or their brother-in-law or their financial advisor who is not really the best choice for the plan. Next one, duty of prudence, just demands that you know this like an expert. You have to have a prudent process and you have to follow it. And if you are not an expert, then you need to hire an expert. But you need to typically hire someone to do searches for you. If you are a plan committee and you've got a great advisor, they're typically pretty good about doing record keeper searches. So leverage your advisor. If you're in a governmental entity, some of those 457 plans still do not have advisors, but think about anything you do every 3 to 5 years. If you only do it once every 5 years, you're probably not an expert at this. And we'll talk about some of the mistakes people make in trying to do RFPs. And then diversifying assets, pretty simple and doesn't relate to this conversation, but in 401k plans, 403b, 457, as long as you have a diversified menu, you should be fine. And then there's a requirement to follow the plan documents. But loyalty and prudence are the 2 that come in here for your fiduciary duties in hiring service providers, right? Are you doing exclusively what's best for the employees? And do you have a process that stands up? All right, here's a great place to start. Meeting your fiduciary responsibilities, publication by the Department of Labor. And for each one of these publications I'm going to highlight from the Department of Labor, I'm going to provide a link to where you can get this PDF. But I mentioned at the beginning is when I'm referring to this document, I've got this picture of the cover page up. This document I want to highlight is like many other, I want to say just publications of the Department of Labor, but and not just government, but if you would read through this, your first reaction, and honestly, my first reaction was, well, that's all nice and good, but it's just too touchy-feely, too 20,000 feet, and it doesn't really tell me what I need to do to make this work. I can maybe hit some check marks, but I dug down into this to get some key, what I call keywords and tricky phrases. But if you really digest some of the phrases here, it has some excellent guidance on how, not just meeting your fiduciary responsibilities, but only the couple pages in here that talk about selecting your service provider. So if I have this image on the right, the language on the left is not a copy and paste, but pretty much identical language. So hiring service providers is a fiduciary function. You decide who your advisor is going to be. You decide who your record keeper is going to be. When considering prospective service providers, provide each of them with complete and identical information about the plan so that you can make a meaningful comparison. Let's say you're going to take your record keeper out to bid. Your incumbent record keeper obviously has more information than any other record keepers. What the Department of Labor is saying, it is your duty to give all of that information to the other potential service providers, whether it's advisors or record keepers. Your incumbent already has somewhat an advantage. You shouldn't make it an unfair advantage by not providing the information to all these other entities. So the lesson you need to take on this is when you're doing a competitive bid, and in most cases for medium to large size plans, that's going to be a formal request for proposal. It doesn't have to be. It can be just a competitive bid. Hey, give us a proposal. But make sure it's a level playing field when you do this. Now, here is where I get these color-coded words in here, and some of these get pretty interesting, the number of colors I've used, right? This is a pretty important point, and I want you all to walk away with one or two specific items to take back to your committee or as an advisor take on in your practice or even talk to your committees. And you're going to find some of that in this color-coded language. Let's look at what's in red here. For a service contract or arrangement to be considered reasonable, I'm just going to pause there. What do we mean by reasonable? And the Department of Labor never defines reasonable. And in all my conversations with DOL examiners, as long as the fee structure is not egregious, and they won't define what egregious is, but if it's high, the Department of Labor is not going to say that is unreasonable, right? But what they will say, and let me continue to read, service providers must provide certain information to you to include all the compensation they will receive. Now you can write this down, and this could be one of your lessons. If you do not have these disclosures, then the Department of Labor will consider your arrangement to be unreasonable. And look at the words there. To be considered reasonable, these service providers must provide certain information to you. Okay? And that's found in the 408B2 fee disclosures for you. So every third-party service provider, they're called covered service providers. Sometimes you'll see the Department of Labor abbreviate it as CSP, but they must provide you their fee disclosure. Now, here are some of the ins and outs and the details with this. When I was an advisor wearing that advisor hat, proposing to be the new advisor for a plan, we'd ask them for several documents. And we'd ask for the what are called the 404A5 disclosures. And those, most of you are familiar with, that's the disclosures that the employees get when they become eligible for the plan, and they're required to receive them once a year. So any document that you as an advisor, a committee member, an HR professional, if you've got to touch it once a year, odds are you're familiar with it. Routinely, I'd get those, but when I'd ask for the service provider's fee disclosure, more often than not, the plan would have a problem coming up with those. And the requirement is that your service providers give that to you at inception or when something changes or on your request. There's no requirement that they give that to you annually. So if it's been 4, 5, 6 years since you hired your advisor, 4, 5, 6 years since you hired your record keeper, and nothing has changed, then they haven't had to give you a fee disclosure in 4, 5, 6 years. Now, here's the last piece of the puzzle. All of the compensation they will receive. Now, typically for your advisor, this is a little more straightforward, but let's start there with what could be different than what's in the notification. If your plan is paying for your advisor and your advisor quotes you, our fee is 20 basis points on plan assets, then the requirement is that the advisor show you 20 basis points is what we would charge the plan. But nothing requires your advisor at the end of a given year to say, this is the dollar amount of compensation we earned. So a good practice in monitoring your service providers is once a year, go to them and say, give us an accounting on how much total dollars you earned from our plan or that we wrote you a check for. Now, in most of these cases, the advisor number is going to be a little more transparent. And when I say a little more, I'm not saying that it's not transparent, but this 20 basis points is an example I give you. Well, how much that is in dollars? We got to do a little math to do that. The record keeper is not quite so straightforward. The record keepers will quote you a cost, but then there's a cost for loans, withdrawals, quadros, and you just don't know what that's going to be in a given year. And let's say that you have a record keeper with some of their proprietary products. Let's say that John Hancock is your record keeper and you have a John Hancock stable value account, or you're using John Hancock's managed account service as part of the plan. They will give you, kind of similar to the example I gave in the advisor, here's what we're going to make off of this X percentage of the assets. But when you get that notice, you don't know how many dollars will go into the stable value account. You don't know how many employees will use the managed account service. So it's very important at the end of a given year that you ask your record keeper, how much did you make? And the one that is the most nebulous is what was earned on float income. If you look at your service agreement with a record keeper, more often than not says, hey, we're likely going to earn a little bit of float income. As you send in contributions, they might sit in our account for a day, and it's not a whole lot of money on your plan, but it's not consequential. And look at that. But here's where it can become consequential for large plans. When there are participants that leave and get cashed out, the record keeper cuts a check, but until that check gets cashed, the money sits with the record keeper and they are earning float income. So this float income thing, I don't want to make that big of a deal out of it. The big picture is you need to make sure you've got all these disclosures or the Department of Labor says your arrangement's not reasonable. And you need to check each year as part of your monitoring process, how much did you as a service provider make? And here is a great summary of what I just talked in another document. And again, as I send these out to the attendees, you look here in the lower left-hand corner is the URL where you can download this. This language right here is just this italicized language that's over to the left, which you can't quite read. So I've blown it up a little bit. Selecting and monitoring service providers to act prudently, we went over the duty of prudence, solely in the interest of the plan's participants. You, the plan fiduciaries, must ensure the arrangement is reasonable and that only reasonable compensation is paid for services. Take us back to the last page. If you don't ask every year, how much did you as a service provider earn from our plan, then you're not really fulfilling that duty. Fundamental is obtaining information sufficient to enable them to make informed decisions about the services, the cost, and the service provided. This last sentence, and really what our business decisions boil down to are we getting good service from this company? It doesn't really say that, hey, you must get good service, but they say that service you get and the cost needs to be reasonable. But you do have to look at this from time to time and say, is there a better arrangement? Bonus information for you. This is not about your retirement plan, but I am getting asked more and more over and over, what is next in the class action litigation world? And my answer is issues with healthcare plans. And in fact, this field assistance bulletin, and again, 2021-03, I've got on the right-hand side and lower left-hand corners where you can find this. But this is a memorandum about the Consolidated Appropriations Act, which brings to the healthcare plans similar requirements to what the fee disclosures were for service providers in retirement plans. In fact, if you read most of this field assistance bullet, it says until we get, and yes, it's almost 2 years old now, but until we get something more formal, this is an interim enforcement policy that we're going to rely on everything we did from the retirement world on fee disclosures. And for your healthcare plan, you've got to do something similar. You've got to keep an eye on these service providers to figure out how much are they making and are the fees reasonable. All right, let's talk about these disclosures. And I've talked about it a little bit, kind of a little bit of a different spin. What are their possible sources of revenue or compensation? So the most simple, and I recommend that you do this wherever possible. If you're a committee member, you're a plan sponsor, pay for third-party service providers through a direct invoice. In other words, the company is paying, not the plan. And I recognize that's a line item on your budget, but when it comes to the retirement plan, those costs are pretty small compared to what you're paying in healthcare. But a direct invoice, you get a bill, company writes a check, pays for that service. Right? It makes it straightforward. It's easy for everybody to understand. And no one can ever question if you're paying the right amount, too much, or too little from a compliance standpoint. The Department of Labor, if they look and see that your company is writing a check, there can be no issue with that. You need to make a smart business decision, but the Department of Labor says, oh, company, you're writing a check? Great, because that doesn't impact the employee inside the plan. So the next one is you do have that money taken out of the participant accounts. And when I say direct debit, that comes in one of two ways. Maybe it's $60 per year, where every quarter $15 comes out of everybody's accounts, or it can be 0.1%, 10 basis points, where everybody has a debit based on their account balance. So one way your record keeper makes money, and this is typically not how the advisor does, is it's debit based on account balances. Now, your advisor typically would have it come from the record keeper first, but advisor can do the direct invoice. Now there's this concept of revenue share, which some of you are probably very articulate in, some of you are very new to this, but the idea of revenue share is some of the funds in your plan would have an extra expense built into it, and that money first goes to the record keeper, and then that can be used to pay your third-party service providers, pay your record keeper, pay your advisor, maybe pay your auditor if there's money left over for that. But the revenue share, we're getting into somewhat a little bit more nebulous territory. Is it okay to do that? Yes. In fact, a story for you from class action litigation. The couple times I've gone to court, every time a decision comes out, first thing I want to do is get the judge's decision and see if I've been quoted out of context. And for the last case that I was a witness on and I testified in court, I was only quoted once, and it said expert Dyson stated that revenue share is a typical arrangement in 401k plans. And I'm okay with that because that is true. Revenue share was an issue with this plan on how it applied, at least in my mind. But I did state to answer the question that revenue share is allowed and it's not uncommon. So your plan can use this, but If you're a committee member and you're using revenue share, make sure you understand that. Now, at the beginning, I said this isn't about fees, but I would dabble in fees. Remember, the point here is how much is your record keeper making? How are you monitoring that? Now, let's talk about use of proprietary products. I gave you the example of John Hancock's the record keeper. Hancock uses a stable value. Well, they're getting revenue for that. So let me give you kind of a generic example and what you need to look at and talk about. Let's say you're searching for a new record keeper. And on one side, record keeper A has what we call an open architecture bid, meaning you can use whatever investments you want. That their fee is higher than record keeper B. And this is for the open architecture bid. You don't use any of their products. But now we get into a proprietary product where if the revenue share now maybe can tip the scale. In other words, vendor A says, well, if you use our stable value, we recognize we're going to get a little more revenue. They lower the record keeping costs, and now it's lower than option B. The first question you need to ask is this proprietary product appropriate for our participants? Okay. In other words, if it's a stable value, do we like the stable value? Ask your advisor to help you out. If it's target date funds, let's say you're looking at T Rowe Price for your record keeper, and T Rowe Price says, hey, if you use our target date funds, we will lower our record keeping fee, and that makes a very attractive record keeping fee. The first question is, are the T Rowe Price target date funds appropriate for our plan, appropriate for our participants? And there's argument either way on this. You just have to make an informed decision where proprietary products are appropriate. You could consider it, but look at how it impacts all of your participants and look at how it impacts all of your fees. And then the last part about float income, I've already talked about that typically float income is pretty small, but the places to look at are how does your service agreement address float income? All right, now we're back to language in the Department of Labor guide. So the last couple slides, right, these that had different graphics were not from that Department of Labor document. But now I'm back into language in meeting your fiduciary responsibilities and just a couple pages on selecting service advisors. Two very important points here. Document the selection and monitoring process. Now, an overused phrase in our business, document, document, document. Well, what does that really mean? I would suggest that if you're doing an RFP for a record keeper, that all the committee members during final presentation should be taking notes. Advisor XYZ said this about their education process, which doesn't seem like it meets our needs. Well, make copies of those committee member notes and hold on to them. You've got the whole RFP process, but things like I mentioned that, hey, at the end of the year, we asked our record keeper, please give an accounting of all the fees that we paid to you. All right. That's typically not going to be a riveting conversation for the entire committee to have or to go through that process. But those are the kind of things that you need a system, advisors, you need to coach your plans on. How do you store this information? Where do you store it? Notes from committee members. Those things are important in documenting this process. And then the one that I think is left out over and over and over is this last one. Educate committee members on their roles and responsibilities. You all are here, you're getting the training, but specifically, I want to address committee members' education for selecting and monitoring third-party vendors. Again, this is something that a typical plan will do a search every 3 to 5 years. We're going to go over where that language comes from. But you're not an expert if you do that every 3 to 5 years. And committee members can use a little education on what this process needs to look like. So make sure you document it. Make sure your committee members get education. Anytime I am doing a search on behalf of a committee or just doing a request for information, I put step one is I would like to have a session with your committee and give them some education on this topic. Very briefly, but important. And I decided how much time I was going to cover this in the session today and decided I didn't want to spend too much time. But obviously, in this day and age, cybersecurity is a bigger and bigger deal. Same thing here. The publication of the Department of Labor will give you just about all the information you need. Lower left-hand corner here, as you get a copy, it will show the website where you can go download this PDF. Now, left-hand side, the bullet points, Department of Labor and EBSA publication. EBSA is the Employee Benefit Security Administration. Hopefully you can see that on the right-hand graphic. But there are 12 elements. And look at the graphic on the right where it says, have a formal, well-documented program, conduct a prudent annual risk assessment. They outline kind of what you need to do in each one of these 12 items. So let's look at the second bullet point. This applies to both you as a plan sponsor and your service provider. You, on your servers at your company, you house all the information to do wire transfers and bank information and social security numbers and date of births and all this identifying information for your participants and what goes into accessing your record keeper. By the same token, your record keeper houses all the information that a cyber breach could cause a loss of funds. So as part of your selection process of your record keeper, you have to ask these questions of your record keeper, and you need to ask these questions of yourself, how your internal processes are. But the topic today is choosing service providers. Now, what about advisors? What do you need to see for cybersecurity program for your advisors? Well, if they're housing information that could be a threat to your account, then yes, you need to see this information from them. For the most part, advisors don't hang on to participant names, social security numbers, user ID, password at your record keeper. So I don't want to say you don't have to do it from the advisor, but just kind of be aware that your advisor, your ERISA attorney, your auditor, these are questions to ask, basically how are they handling it? But I don't think it is nearly an in-depth ask as you need to ask yourself and your record keeper. So go get this document, review it, and that's another help. So now we'll get into the more practical items. We've left the world of the Department of Labor publication. So far, I've talked about competitive bids. Let's talk about benchmarks. So a benchmark would come in somewhat different flavors, but generally speaking, you're looking at, this is the size of our plan. This is the rough service we're providing, and this is the cost for it. And it's compared against a benchmark group. For the most part, you're just comparing cost of your plan to another plan. And that can be the cost of record keeping or the cost of the advisor. Now, there are ways to build into these benchmarks a little bit of qualitative issues. And depending on the service you use, some are more in depth than others. I have looked at a lot of these as an expert witness, and where there are problems, it's almost always there's a problem in either entering or interpreting data, or the worst case is the data is there that says the plan should do something and nothing happens. In fact, sometimes it's in the committee that, yeah, we probably need to take this out for bid, but we got to work about the healthcare plan, so we're going to put that off in a year. And we probably should take this out to bid, but it's 2020, we have too much going on with the pandemic, so we're going to put this off for a year. And there are all these reasons to kick the can down the road. So this is a safe way, I say, of looking at benchmarks. Benchmarks can quickly tell you if you're out of bounds. Holy smokes, look how much we're paying for this service, and compared to others, we need to do something. And the immediate ask might be, go back to that service advisor or service provider, your advisor, your record keeper, and say, hey, look, we've got this benchmark. It appears that we are overpaying for services, but we need to talk about this. And you may get a fee negotiation that very quickly brings you back into bounds. All right. A benchmark is not a replacement for a competitive bid. Now, a competitive bid does not mean you have to have a formal request for proposal, but let's go to the next bullet point. Is a request for proposal required every 3 to 5 years? Let me tell you where this language comes from. In the language that the Department of Labor issued for the 408B2 disclosures. And remember earlier we talked about this. Your service providers need to disclose to you all the fees that they're making. In the Department of Labor guidance, they use language that says the Department of Labor assumes that plans conduct a formal request for proposal at a minimum interval of every 3 to 5 years. Okay. It uses the word assume. So number one, it does not mandate that plans do this formal request for a proposal every 3 to 5 years. But the Department of Labor assumes. So I would suggest that for most of you, most of the people I talk to, you're in a plan size that's 20 million, 50 million, 100 million. You're not exempt from litigation, but that's not where we see class action litigation. So you're more likely challenged from a risk perspective and a audit perspective is if the DOL comes in to audit your plans. Well, they're assuming that you've done this every 3 to 5 years. I think it would be a good idea to do this every 3 to 5 years. That's where the language is. The Department of Labor assumes that you do this. The next thing we've touched on briefly, investment decisions versus record keeping decisions. I have seen what I consider to be very poorly written RFPs for record keeping services, where the question set that goes from the plan to the record keeper says, hey, show us what your services would be, how much it would cost for record keeping, and what would the investment lineup be? Well, the investment lineup should be totally separate from the record keeping decision. It has nothing to do with record keeping. And I've already gone over the example, this investment decision and the next bullet point, use of proprietary products. They are closely related, but you need to separate them. All right. So going back to a example that I've already given, record keeper A has a price here, record keeper B has a price here. But if you use their target date funds, it goes to this. Record keeper A looks better, but only if you use their target date funds. So question number one is this proprietary product? Is it appropriate for our plan by itself? And then just document your decision. And the last point I have for you, if you're asking either an advisor or a record keeper to propose for services, I very strongly suggest that you ask them for both a flat fee and an asset-based fee pricing. As a minimum, ask them for a flat fee. Now, a couple things to go on here. The details are important here. So flat fee for a record keeper would be, hey, we will charge you $60 per participant per year. We will charge you $20 per participant per year, depending on your plan size, average account balance. I can't say whether 20 or 60 is right. As opposed to them saying, we're going to charge a 0.25% per year or 0.10%. That would be asset-based pricing. Now, some record keepers, just to be clear, to be transparent, to be fair, some record keepers who are very good at this, nationally known, some segments of the market, they will only price it one way or another. They would say, no, we only give it in a per head price, or we only give it on an asset-based price. And you can ask if they say, well, this is the only way we do it, just make sure you document that. For your advisors, I would suggest the same thing. Ask them to quote it on a flat fee. In other words, we will charge you $30,000 per year, or we're going to charge you 30 basis points on $10 million. That math would work out roughly to be the same. But expect for the advisor, if they charge you that flat fee, they're probably going to build in a cost of living adjustment. You know, hey, we'll start out at $30,000 and it will go up 4% every year. You can obviously work into your service agreements if the plan decreases in size by a certain amount or increases, that it would be renegotiated. So that's kind of some of the more practical items, but want to go into common questions. And these common questions are also going to give you some practical steps. First one, I almost always get this. How long will this take? Let's face it, we're busy. Committee members, you're busy. Advisor, your clients are busy, you're busy. The question is, how long will this take? And question number two, how many hours of my time will it? I can tell you a minimum, this is going to take 60 days, probably more like 90 days as a minimum from the time somebody says go to do an effective advisor search or an effective record keeper search. That's start to finish. Now, how long and how many hours is just people saying, I want to get away doing as little effort as possible on this. And you as committee members, you need to understand, and advisors, you need to understand and make your committee members understand, as we went over in the DOL guidance, this is a fiduciary act. And sometimes I want to sound like a parent and say, this is going to take as long as it takes. Now, I don't say that. That's what I feel like saying. But how many hours of my time will this take? There are a couple ways to make this easy and break it up. So here are some practical steps I like to take. Is it's possible that the entire committee delegates 2 or 3 members of the committee to run this process up until the part that you're inviting finalists to come in and present. So you, 2 or 3 members, you're tasked with rolling up your sleeves, reading all the proposals, kind of coming up with a good, bad, and the ugly for each vendor, writing up a summary and presenting that at the next off-cycle meeting that we'll have on this topic, right? The whole committee doesn't have to do it. Another way to do it is I call divide and conquer. Let's say you get 6 proposals from 6 different vendors that maybe 2 committee members or and depending on the number on the committee, right? 1 or 2 are side, hey, you review the proposal from vendor A, you review it from vendor B, and that each person is assigned to review one of the proposals. Now, depending on how strict or lenient or critical someone is, that may make it a little unbalanced, but it's still a way to take this task that is pretty lengthy and pretty complicated and break it up and do some delegation. And then certainly, again, if you hire somebody to help you out, they can walk you through this. What questions need to be included in the RFP? Stick with me on this one. Do not just simply download a template off the internet, use that and send that to your vendors. All right. It will mean that you and your plan are like every other plan out there and you don't really care to make a difference. Here are the couple challenges with these questions. And let me put this into 2 broad categories. The first one is 80% of the very basic questions that you ask all these advisors are all the same. If they're qualified and competent, 80% of what they do is like everybody else. But you need to include those questions. You do need to put the meat and potatoes question, right? Are you under investigation from any regulatory authority? And hopefully they all say no. Tell us about this aspect of your team. What's their experience level? You have these 80% of questions, they're all going to be the same. And hopefully they're not wasting their time putting a whole lot of effort into it other than saying, yeah, we're qualified, here's why. But 20% of those questions, and this is where you can make a difference in the process, is how do you figure out what you need and how each of these firms are different? Now you can ask the question, why and how are you different than other firms we much higher? But look to fit in there. Other questions are going to help you out. How will you make it easy for us to understand your investment policy statement? How will you make it simple for our committee to follow the quarterly investment monitoring reports? Okay. So that's one side of it, this 80-20 rule, that 80 are going to be basic and 20% figure out, are they different and are they well suited for you? The other side to it is, we talked about conflicts of interest, and I want to bring that up here, is all these vendors have a responsibility to disclose their conflicts of interest to you. You have a greater responsibility as committee members to uncover those. So there needs to be added these questions that uncover conflicts, and they need to be a little more complicated than just saying, do you have any conflicts? And they'll say, refer to our ADV part 2. No, we don't have any. You need to dig a little bit. And the conundrum, and this is really, it depends on preference. More questions leads to more disclosure, but it also leads to a longer RFP and more time for you to review. The other question, how much will it cost? Obviously, if you're doing it on your own, that it's not going to cost you anything. It's just going to cost in terms of time. But depending on the scope of the firm you hire, depending on the size of your plan, if you outsource this, it's anywhere from a $20,000 to a $60,000 project. I'm just giving you that number if you outsource an RFP. Does it need to be a formal RFP? Ideally, I think it is, but it doesn't need to be. Let's say you're a smaller company, your plan's $5 million and you're hiring your advisor for the first time. You can go to 2, 3, 4 reputable firms, get the names from maybe your accounting firm who does audits. I can certainly do that for you. If you don't want to hire me, I can still refer you to advisors who can do this process for you and just say, hey, we'd like your proposal. We want to interview you for 30 to 60 minutes and document the process. How often do you need to do this? I think every 3 to 5 years is reasonable. Now, the last question, this one's always a big one. How many vendors do we need to include? Okay. When I get hired, the question is always, Eric, how many vendors will you evaluate for me? And my answer to this question is, how many vendors do you need to include? Only as many as you're willing to review. You can't ask 10 firms to give you a response to an RFP and decide once you've gotten you've reviewed the fourth one to decide, yeah, this was a bad idea. This is taking too long. All right. What I like to see when I'm doing an advisor search is initially talk to 8 firms, do screening interviews that last about 30 minutes. They can be Zoom or in person, and get a personality fit and have the committee member or representatives from the committee saying, hey, these are the 4 we want to move forward with. But it's critical that you not have too many and not review them. Top 10 mistakes. In the interest of time, let's go through these real quickly. If you'd like this white paper that I've written, you can also respond to me when I send out the copies of the presentation. Hey, please send the top 10 mistakes. Number 1, not doing it because it's too much time, money, and effort. We kind of just went over those are the questions. Asking questions that don't differentiate. That's the 80-20 thing I talked to you about. Not adequately addressing conflicts. You need to ask very pointed questions. And it's not a matter of being combative. It's just a matter of disclosure. Ask questions that focus on results. Don't say, tell us a little bit about your education for our employees. Give us an example of an education campaign you did for another client that made a results. Number 5, I've already highlighted this. I think there's a personality fit that's very important. And for you to do this screen first makes your time more efficient. It's an investment of time up front, but it's more efficient. Educate committee members on this responsibility. Document the process. Understanding fiduciary roles, meaning your record keeper is typically not a fiduciary. If you hire an advisor as an ERISA 338 advisor, that does not unload all of your fiduciary responsibilities. Number 9, I see a lot, and I see this in day-to-day committee meetings. When you come to a committee meeting as a plan fiduciary, whether you're the benefits manager, the director of HR, the CFO, the CEO, doesn't matter. You are all wearing equal hats, having an equal say as plan fiduciaries. And many times the C-level executives will say, well, we're not going to do that. This is what we're going to do. And because of the corporate hierarchy, everyone else in the committee will many times just shut down. And the worst case that I've seen is the C-level executive shows up only at the finals presentation, doesn't show up for the finals for all of the vendors, and whichever one he or she sits through decides, yeah, just go fix that, and that's the one that we're going to go with, and doesn't really participate in the process. And the last one, get help if you need it. Important disclaimer stuff. Not all this applies to all of you. Your plans differ. So I'm about to get to the key word for you if you need SHRM PDC. But this, if you're a QR code user in your phone, my next webcast will be about selecting and monitoring target date funds and what the Department of Labor says about that. If you want to scan that with your phone, that will take you directly to the registration page for the December 13th webcast, and there will be an hour of SHRM PDC available as well. Keyword benchmark. So if you need SHRM PDC, or if for whatever reason you're a committee member and you don't have a SHRM designation, and certainly this will give you credit towards other HR professional designations. But if you'd just like a certificate to say, hey, I participated in fiduciary training, I'm not as concerned with the keyword, but just send me an email, eDyson@90northllc.com, keyword benchmark, and say, yes, please send me a certificate. And that's it. We've got just a couple minutes left, 5 minutes. So I will open it up to questions. This QR code is the same QR code for the committee checklist I mentioned. And the last one I'll leave up there is my contact information to connect with me on LinkedIn. So 5 minutes left, ladies and gentlemen. We've met the SHRM requirement for you get 1 hour of PDC, and we've made that work